common investment mistakes, and how to avoid them. Investing can be one of the most powerful ways to build wealth over time, but it's also surprisingly easy to sabotage your own success. We're going to examine 7 critical mistakes that cost investors billions of dollars every year, and more importantly, how you can avoid them. Whether you're just starting your investment journey or you've been at it for years, these insights could make the difference between mediocre returns and building real wealth. Let's dive in. Mistake number 1. Emotional investing. The first and perhaps most costly mistake is letting emotions drive your investment decisions. Fear and greed are the twin destroyers of investment returns. When markets crash, fear takes over. Investors panic and sell at the worst possible time, right when they should be buying. Conversely, when markets are soaring, greed kicks in, leading people to chase hot stocks at peak prices. Research by Dalbar consistently shows that the average investor underperforms the market by 3 to 4 percentage points annually, largely due to emotional decision-making. Over 20 years, this emotional penalty can cost you hundreds of thousands of dollars. How to avoid it? Create a written investment plan when markets are calm. Set specific criteria for buying and selling that remove emotion from the equation. Consider dollar-cost averaging, which involves investing a fixed amount regularly regardless of market conditions. This strategy naturally buys more shares when prices are low and fewer when prices are high. Remember, time in the market beats timing the market. Mistake number 2. Lack of diversification. The second major mistake is putting too many eggs in one basket. Many investors concentrate their holdings in a single company, sector, or even country, creating unnecessary risk. Consider employees who had their entire retirement savings in company stock. When companies like Enron collapsed, they lost not only their jobs, but also their life savings. Even successful companies can face significant declines. Apple fell over 80% during the dot-com crash, and Nokia, once the world's largest mobile phone manufacturer, saw its stock decline by over 90%. Lack of diversification extends beyond individual stocks. Some investors only buy growth stocks or only invest in their home country, missing opportunities and increasing risk. How to avoid it? Spread your investments across different asset classes, sectors, and geographic regions. A simple approach is to use broad market index funds or ETFs that instantly give you exposure to hundreds or thousands of companies. Consider including bonds, international stocks, and even real estate investment trusts in your portfolio. The goal isn't to avoid all risk, but to ensure that no single investment can derail your financial future. Mistake number 3. Trying to time the market. Market timing is the attempt to predict future market movements and invest accordingly. It sounds logical, but it's extraordinarily difficult, even for professionals. Studies show that missing just the 10 best trading days over a 20-year period can cut your returns in half. The problem is that these best days often come right after the worst days, when investors are most likely to be sitting on the sidelines. Even professional fund managers struggle with timing. According to Spiva scorecards, over 80% of actively managed funds fail to beat their benchmark index over 10-year periods, often due to poor timing decisions. How to avoid it? Accept that you cannot consistently predict short-term market movements. Instead of trying to time the market, focus on time in the market. Develop a long-term investment strategy and stick to it through market cycles. If you feel compelled to make tactical moves, limit them to a small portion of your portfolio, perhaps 5 to 10%. Keep the majority of your investments in a steady, diversified strategy. Mistake number 4. Chasing past performance. The fourth mistake is chasing yesterday's winners. Investors frequently buy funds or stocks that have performed well recently, assuming that past performance predicts future results. This behavior creates a destructive cycle, buying high after strong performance and selling low after poor performance. Morningstar studies show that investors in mutual funds consistently earn lower returns than the funds themselves report, primarily due to poor timing of their purchases and sales. The technology bubble of the late 1990s provides a perfect example. Investors poured money into technology funds after years of spectacular returns, only to see these investments collapse when the bubble burst. How to avoid it? Remember that past performance does not guarantee future results. This warning exists for good reason. Instead of chasing hot performance, focus on consistent, low-cost investment strategies. When evaluating investments, look at long-term performance across different market cycles, not just recent returns. Consider the underlying fundamentals and whether the investment fits your overall strategy, rather than simply following the crowd. Mistake number 5. High fees and expenses. Many investors underestimate how seemingly small fees can devastate long-term returns. A difference of just 1% in annual fees might not seem significant, but compounded over decades, it represents a massive drag on wealth building. Consider 2 investors who each invest $10,000 annually for 30 years with a 7% market return. One pays 0.1% in fees through low-cost index funds, while the other pays 1.5% through expensive actively managed funds. The low-fee investor ends up with over $200,000 more. That's the power of compound interest working for you instead of against you. High fees are particularly problematic because they're guaranteed costs, while returns are uncertain. You pay the fees regardless of whether your investments perform well or poorly. How to avoid it? Always examine expense ratios before investing. For broad market index funds, you should typically pay less than 0.2% annually. For actively managed funds, anything above 1% should raise red flags. Don't forget about hidden costs like trading fees, load fees, and 12B-1 marketing fees. These can add significantly to your total cost of investing. Consider low-cost brokerages and be particularly careful with variable annuities and complex financial products that often carry high embedded fees. Mistake number 6. Inadequate research and due diligence. The 6th mistake is making investment decisions based on tips, headlines, or superficial analysis rather than thorough research. Many investors buy stocks because they heard about them from a friend, saw them mentioned on social media, or read a single positive article. This approach often leads to buying overvalued companies or falling for investment scams. The meme stock phenomenon of 2021 demonstrated how social media hype can drive stock prices far above their fundamental value, ultimately harming investors who bought at inflated prices. Inadequate research also means missing red flags. Investors who thoroughly researched companies like Theranos or FTX before their collapses would have discovered significant warning signs that could have saved them substantial losses. How to avoid it? Before making any investment, understand what you're buying. For individual stocks, examine financial statements, understand the business model, and research the competitive landscape. Look for companies with sustainable competitive advantages, strong balance sheets, and competent management. For funds, research the strategy, holdings, and track record of the management team. Don't invest in anything you can't explain to someone else in simple terms. If you don't have time for detailed research, consider broad market index funds, which give you exposure to the overall market's returns without requiring you to pick individual winners. Mistake number 7. Neglecting tax efficiency. The final major mistake is ignoring the tax implications of your investment strategy. Taxes can significantly reduce your net returns, yet many investors focus solely on pre-tax performance. Frequent trading generates short-term capital gains, which are typically taxed at higher rates than long-term investments. In many jurisdictions, holding investments for more than 1 year qualifies for preferential long-term capital gains treatment, with significantly lower tax rates. This difference can substantially impact your after-tax returns. Additionally, many investors hold tax-inefficient investments in taxable accounts while keeping tax-efficient investments in tax-advantaged retirement accounts. This backwards approach costs them money every year. How to avoid it? Develop a tax-efficient investment strategy. Hold tax-inefficient investments like bonds and REITs in tax-advantaged retirement accounts, while keeping tax-efficient investments like broad market index funds in taxable accounts. Minimize unnecessary trading to avoid short-term capital gains taxes. When you do need to sell investments, consider tax loss harvesting to offset gains with losses where permitted in your jurisdiction. Take full advantage of any tax-advantaged retirement accounts available in your country. These accounts, whether they're called pensions, superannuation, or retirement savings plans, can significantly boost your after-tax returns over time. Conclusion. Successful investing isn't about finding the next big winner or timing the market perfectly. It's about avoiding these common mistakes that destroy wealth over time. To summarize, control your emotions with a written plan. Diversify broadly. Stay invested for the long term. Ignore past performance. Minimize fees. Do your research and invest tax efficiently. The good news is that avoiding these mistakes doesn't require genius-level intelligence or access to insider information. It simply requires discipline, patience, and a commitment to proven investment principles. Remember, building wealth through investing is a marathon, not a sprint. The investors who succeed are those who avoid these costly mistakes and let compound interest work its magic over decades. Start implementing these strategies today, and your future self will thank you. Feel free to share your thoughts on investing mistakes or investments in general in the comments. If you would like to receive more content like this, or if you would like to help others find this channel, please subscribe.